Ladies and gentlemen, welcome. Welcome to the £1 billion panel. My name is David Mott. I'm the co-founder and managing partner of Oxford Capital, and I am excited. Have you noticed how everybody is talking about venture capital, entrepreneurship, £1 billion exits, IPOs? What's going on? Well, from my vantage point of having started Oxford Capital, invested in a current portfolio of about 25 companies, picked from thousands from around the UK and beyond, including several here in the Oxford cluster, I'd like to share with you a few thoughts on a few observations that I've noticed. 6 of them in particular. First, significantly more of our best technical graduates are becoming entrepreneurs. It's the new investment banking. Just look at the Oxford Entrepreneurs Society. It is the largest student society in Europe, and it is here in Oxford. And successful entrepreneurs are doing it again. There are more repeat entrepreneurs now than there ever have been. So the talent pool is growing. Second, technology trends are enabling much lower startup costs of businesses. The costs of storage, bandwidth, and processing are now 35% less than they were 5 years ago. So it's easier and cheaper to become an entrepreneur. Third, the UK has one of the most vibrant and prolific angel investor environments in the world. In fact, we produce about 300 new startups a year, and that's comparable to Silicon Valley. So there are more companies. Fourth, in the last 2 years, the number of company accelerators in the UK has tripled, and major UK corporates are getting into the act and funding these programs, such as Telefonica, and most recently Barclays announced a multi-million-pound support accelerator program. So there is more support for entrepreneurs as well. Fifth, successful entrepreneurs are themselves becoming early-stage VCs. Thanks to schemes like EIS and SEIS, they are funding the output of accelerators and from universities. And last year, the total amount invested in early-stage companies exceeded £250 million. So there is more risk capital available for entrepreneurs. And finally, the news flow of exits in 2014 to date has exceeded 10-year records. Great companies don't have to go to the valley anymore. They can get noticed and grow and be very successful here in Europe. And the UK is doing especially well. Some of you may have heard the term unicorns. Unicorns are billion-dollar businesses that have grown and been established within the last 10 years. We have 11 of them here in Europe, more than any other country by a factor of 2. And a lot of VCs, including ourselves, have some great companies in our portfolio, and I think we'll see a lot more of those in the coming years. Now, many of us remember the bubble explosion of 2001, and you may ask, are we warming up to the same cycle here? Well, Mary Meeker, the internet analyst, highlighted that, recently that IPO and investment values remain well below historical peaks. And in 2013, last year, VC funding was 77% below that of 2000. So there's a long way to go. Today, tech companies represent 19% of the Standard & Poor's total value versus 35% in 2000. So these are good times to be an entrepreneur, but not bubble times. My message is that it's a great time to be starting a business. Building a sustainable and successful, profitable company is still really tough, but it's easier than ever to try. But what makes me even more excited is to see what's going on our own doorstep here in the Oxford cluster. Many stars are emerging: Immunicore, Oxford Nanopore, Oxitec, to name but a few. And some have already emerged, and this is the focus of our panel. Today, we have 2 companies who've been acquired by US tech companies: a London IPO, a NASDAQ IPO, all of which have taken place within the space of a year here in the Oxford cluster. Their aggregate value is over 1.2 billion pounds, not dollars, pounds. That's nearly $2 billion. It's a record year for Oxford. This has never happened before, and I'm absolutely thrilled to introduce to you Peter, Shirin, Ian, and Adam. Welcome. If I could just ask you each to start off by introducing your business, and perhaps you could just summarize the journey you went through to the exit point. Peter, do you want to start with you?
So Peter Wright-Smith, Oxford Immunotech. Oxford Immunotech started 12 years ago as a spin-out from science based here at the University of Oxford. True startup. I was the first employee, and over 12 years we've taken an immunology technology to the market in over 50 countries now. And we have grown revenues at about a CAGR of 70% over the last several years to around $40 million. We raised 5 rounds of venture capital along the way, and we recently completed an IPO on NASDAQ last year at $74 million raised. We are a UK domiciled company, but chose to list on NASDAQ. I'll be happy to discuss why we took that choice to anybody who's interested. And we have about 200 employees on 3 continents. Very global business. Thanks.
Sure.
Thank you, Vita. My name is Shirin. I founded Ariso 12 years ago, and we were a software company in the mobile communication industry. Our software basically looks at how the experience of subscribers are and reports these back, collects the data, reports it back to mobile operators. So our customers are likes of Vodafone, O2, AT&T, and we have a global company. We've grown the business CAGR of around 50 to 60% a year over the last 6 years. And today the revenues of the company are around 40 million. Of course, it's now a division of a much bigger company because we exited last year. However, the business unit still continues as a standalone, and we look forward to growing this business even further to about 100 to 200 million in the next 3 years. In terms of the funding rounds that we received, we had 3 funding rounds, 1 seed A and B, and it was around £9 million that basically the business raised. So that's me. Thank you.
I'm Ian Crosby, Head of Corporate Development at Circassia. I joined the company last November, so I'm a relatively new boy in this whole regime. Circassia was founded in 2006. It's a biotech company. We're not working on cancer, we're not working on rare disease, we're not working on any of these fancy areas that everybody focuses on these days. What we're working on is the biggest loss to productivity in society at the moment, which is allergy. There's more people lost days of work through coughs, colds, itchy eyes and the like, and just people, it's rather unloved area of medicine, hasn't been touched in 100 years. So we're developing a range of novel products with 21st century science to address the global problems of things like cat allergy, house dust mite allergy, grass, and ragweed. The company now has about 60 employees, growing up from 20 employees when I joined it in November last year. We have no CAGRs of revenue since we're burning money at a prodigious rate and intend to do so for the foreseeable future. Our lead product is in cat allergy, and we'll report data in 2016. And after that, we will be reporting on 2 more phase 3 trials in 17 and 1 more in 19. There isn't a company like that, like us, coming to the public markets in many, many years anywhere in the world. Everywhere else in the world, companies have previous exit routes, but because of London being shut for so long, we effectively were the kid that was kept home from school and locked under the stairs. So when we finally emerged into the daylight, we didn't really fit anywhere. We go to the US market and people say, well, how come you've grown so far and so long? You can't come here, you're too big. We wanted to raise £200 million. They go, no, you can't do that. We only raise $100 million here. We wanted a pre-money value of £400 million. And they said, no, you can't do that. We do 100 to $400 million. So we went to the US, and the US told us, no, you don't fit here. What you want to do isn't possible. So we went to London, spoke to the investors in London, some of whom have been big backers. We were lucky enough to have Invesco backing us for many years, Lansdowne, Tudor, Goldman, and the like. And we were very lucky to be out in an environment where in the US, the biotech market was very hot, but also importantly in London, there was a lot of private equity exits as well. So we had Poundland, AO.com, Pets at Home, and the like. And all of those guys were raising £200 million. So when we came to ask for £200 million, investors didn't find it particularly odd. So we got £210 million, the biggest biotech IPO in the world ever. And now we're set up for the foreseeable future. We're funded through to profitability and have to hope that the cats behave themselves in the studies.
Great, thanks. So I'm Adam Whittaker from Natural Motion. I joined Natural Motion in 2006, but the company actually was founded in 2001 as a spin-out from the zoology department here at in Oxford University. And it was all based around a piece of technology which is really cool. And what it does is it actually simulates how characters or animals or whatever act and interact. And what we did initially was work out how to simulate characters and teach them how to walk. And then from there we thought, well, okay, that's great, but let's see what we can do with this and try and productionize this. The first product that we took to market was around something that was focused around the film industry. And what this enabled us to do was instead of animating really complex scenes, it was used to basically put these characters in place that normally if you tried to do it with a stuntman, you'd probably kill the stuntman. And that was successful. It was used in things like Lord of the Rings, in Troy, Poseidon, etc. But when we launched that piece of technology, we originally thought, well, that's great, but how do we get really big? And one of the issues that we found with the first piece of technology was that, well, it was the same technology, but the first product was that we were focusing on something that we thought was a huge market, but actually we were selling right in at the bottom in terms of you sell to a visual effects company, they sell scenes to various different parts of the cinema thing, and basically you're so far down that it was never going to be a huge industry. So we thought, okay, well, how do we go big? And all of the things that we've always done throughout the history of the company is think, well, how do we go bigger? And so what we did then was start to talk to video games companies, which were a huge growth industry throughout the early 2000s, particularly with the Xbox 360 and PlayStation 3 coming on board. And what we did, the next step then was to talk to big companies such as Rockstar Games, LucasArts, and we managed to sell in 2006 2 really, really big contracts. Even though we were only like 20, 25 people at the time, we managed to get multi-million-dollar contracts with some of the biggest games in the industry basically ever. Grand Theft Auto, when it launched, was the highest grossing entertainment product ever, including any film or anything. It was ridiculous. So we did pretty well at that point in 2006 to get into both Star Wars and Grand Theft Auto at that point. But from that point onwards, we were still thinking, well, how do we get bigger and where do we go next? And it was all still based around the same technology. So we then thought, okay, well, to grow even more, we should start to develop our own games. So we started to develop games ourselves for Xbox, PlayStation 3. And then actually what happened really interestingly in around 2008, 2009, we saw kind of these devices, iPhones, if I can get it out of my pocket. So I see these devices coming on. We're like, holy wow. These are so powerful, or they will get so powerful that all of our stuff can run on these devices now. And what we did in 2009 was we released our first game on iPhone, and actually we only did it for trademark purposes. We had a trademark that was going to be nullified in the US if it wasn't for the fact that we needed to sell it to at least 2 people across state boundaries. So we did that, and we actually had it downloaded. I think it's now over 15 million times. So that was quite a wake-up moment for the company in terms of you can get from a fairly small area in Oxford, you can get across to millions and millions of people across the world. We then developed the mobile game strategy more and more, and basically where we're at now is we exited the company to Zynga. We're now a very core part of their mobile games business, and our games are now enjoyed by, I think at the last count it was over 210 million people across the world, which is, pretty good. I won't go into the revenues, etc., but they're pretty good. So,
thank you very much, guys. And, you've all built some really successful companies. In a few minutes, we'll open up to the floor for questions. So if you have any questions, put your hand up in a few minutes. But I'd just like to sort of ask the panelists, you've all built very successful, highly valuable businesses. Was there a single point or a moment that defined that value growth in your mind? Peter, you started the company.
So I think I'd like to build on a comment that Adam talked about, which is, I think there's not one moment. What there is a series of successive steps to innovate the company's business model as we confronted reality, as you did. And I can tell you that It all looks great in hindsight, but at the time it was highly uncertain. There were a lot of things at the time we felt were significant setbacks to the company's progress. But instead of ignoring those and just burying our heads in the sand about those, we confronted that reality, and through that, we innovated our business in response to those external forces. And every time we did that, the company was strengthened materially. And so that's one of the key lessons I would give to any of you who are either running or considering running your own businesses, which is persevere, but also adapt. And through doing that, I'm sure you'll be more successful.
Sure, was there a moment in
Yeah, I mean,
Ariso's life?
I'd agree with that. I think you have to adapt your business model. You have to adapt your business. I mean, when we started a very early product. And for the first 5 years, just I guess try to bring that first product into the market, but not sort of realizing some of the I would say elements around sales and marketing, and trying to sort of sell on technology. And perhaps one of the things that really changed the game for us is that when we did launch the second product, which ultimately was the success story for Ariso and resulted in the massive growth and successful exit, is that, you know, having learned from kind of the first phase of that journey, then made sure that, you know, we got the marketing element of it absolutely right, because it all needs to come together. Unfortunately, best technologies don't win. You need all of the other elements around it. So I think that was probably one of the defining moments for the company, where we really stepped up from that perspective in the second phase of the business.
Ian, maybe if I can ask you a slightly different question. You talked about the types of investors you brought on board, and there was clearly a very deliberate strategy in having the same IPOs backing you pre and post IPO. Can you comment a little bit on that? Because
I think
it's quite interesting to hear.
Yeah, absolutely. Getting the right set of investors, it obviously depends on your stage in life. At some point, it's any investor, but as you evolve and you move forward, it's getting the right set of investors on board. Steve and Charles did a terrific job in lining up, getting Neil Woodford really bought into the strategy. Neil's the Rockstar fund manager at Invesco. You've probably seen he's now left and gone to set up his new Rockstar fund.
And he's based in Oxford as well.
He's just down the road too, and staying there again. And he's really been responsible for funding the life sciences sector in the UK, but also with a very, very rigorous background. He's no charity. He clearly has a view as to what makes sense, and he's done very, very well out of that portfolio there. But he alongside Lansdowne, so we had a big long-only fund manager, we had a big hedge fund manager in there as well, and that carries a huge amount of kudos when it comes to seeing other institutions. We managed to bring Odie, another big fund manager, into our IPO, principally on the prestige we generated out of having Neil as part of our investment lineup there. So that carries sort of friends beget friends. So you want to be seen, if you can be seen in the best company, then you're going to be well set up for the future there. That was critical there. Ahead of our IPO, we had a very long, deliberate process of trying to find a group of key investors that would carry through. An IPO is not something you decide one day you want to rock up and do. It's something you have a deliberate process. It starts 6, 9, 12 months ahead of time, where you're talking to people, you're trying to show them your plans. You're trying to say, look, I'm not going to turn up and try and sell you my stock in 35, 40 minutes. I'm going to try and sell it over 12 months. I'll tell you what I'm going to do, then I'll come back and show you what I've done, and I'll tell you what I'm going to do again. And that type of consistency is what people want to see. And if you don't deliver that consistency, then you're never going to get there for the real prestige name. So for us, it was a very deliberate process. We were well set by having those investors right back at the beginning, but Neil has a terrific mindset and mentality towards the sector, and really believes this is a fundamental source of growth for the economy moving forward, and thank goodness for him.
Yeah. Adam,
Yes, it's an interesting one. So,
yeah. How did you get Zynga to
how do we get Zynga?
knock on the door? Did you knock on their door? Did they knock on your door?
No, so that
What was the courtship like?
It's so cliche to say, well, we weren't looking to sell, and actually we weren't looking to sell, and it really was. I was trying to think about the key points that drove to that area there. And as Peter said, there's a lot of serendipity. When you look back, it's like, oh wow, yeah, that trademark thing was brilliant, because that meant that we saw how big iPhones could be, and If we look at other moments as well, such as when we released our game CSR Racing, in the forecasts we were expecting between $100,000 and $1 million in the first month, and we went straight to the top of the App Store, and then we grossed over $12 million in the first month. And we put out a press release about this, and we got people contacting saying, you're lying, that you can't make that amount of money. We're like, actually, yeah, it's we can, and we did, and it's phenomenal. So that was part of all of those success moments. There's lots of different success moments. You can't really pinpoint which was the one that drove to it. Definitely the launch of CSR Racing was huge, but also I think going to Ian's point about getting the right investors in place as well. Around that time, or just before we launched CSR Racing, we got a really good West Coast venture capital on board, Benchmark Capital, in addition to Bolton Capital, who are really good, obviously European fund. And I think the combination of those two, the combination of the successes, really helped us open doors into places that we wouldn't have ever really thought about trying to sell the business to. And those types of connections, those types of relationships, I think really did help drive the business, as well as supporting capital. The doors that they open really help actually create the exit.
Sharon and Peter, I know you both went down different exit routes, but what was the sort of, how long before the IPO or the sale did you start planning that process? Is it part of...
Yeah. When you're venture capital backed, it's a constant process, and we have a very systematic strategy review process every year, and at least every year we'd be reviewing with the board what our current thoughts were on exit. And I think in our case, we recognised that we were unlikely to be an early trade sale candidate because of the uniqueness of our business model, and therefore an IPO was more likely to be a route for us than a trade sale, and so it turned out. However, I have to confess that we thought, given the state of the public markets, it was going to take us another couple of years before we were mature enough to get an IPO away. But then obviously we saw what happened to the capital markets last year in 2013 in the US, and what had become impossible became possible at the kind of revenues and stage of maturity of the business. And so the other thing you have to bear in mind is you have to be able to be prepared, have put the thought in ahead of time, be prepared, and have your house in order to be able to respond very quickly. So I started getting a sense in January 2013 that the markets were changing. We then did a little bit more work talking to bankers, and then we took a decision on July, I think 12th last year, to go for an IPO and appoint bankers, and we were public November, the day before Thanksgiving in the US, so in third week of November. So it took about 4 months to execute, but that was only because of the thought process and preparation that had gone on before that, and in particular the thought process with the board and the investors, such that it didn't take a lot of time to persuade them because we'd already had numerous conversations about this topic in the past. So very important that you constantly assess your exit options, particularly if you're venture capital backed.
Yeah. Sharon, do you want to comment on that at all?
Sure. Obviously the company was growing very fast, and we knew that had generated quite a lot of interest in our industry around the company. And we had essentially put together a program of going out and talking to potential acquirers well before the exit actually happened, at least 18 months. So it's a bit like a normal sales process when you're trying to sell your product. Like selling your company is in exactly the same process. You have to have a funnel. You have to talk to lots of candidates out there. Obviously telling them about your business and making sure they understand the value proposition and the future of the business and the potential of the business and how it might actually fit as part of their strategy. Because that's the other thing, when you're trying to sell your company, you have to understand what the acquirer's strategy and thought process is around that. And it's quite interesting because one buyer could have a completely different reason for buying you than another. So you almost have to become like a chameleon. You have to turn your colors depending on who you speak to. And so we had this, very, I would say, fairly rigid program of going out there, talking to lots of people. Obviously not with a for sale sign, because that's the last thing you want to do. You want to be bought. You don't want to sell. You want to be sold, if you will. And that whole process of talking to external companies took quite some time. But also internally, we made sure that we got our house in order, made sure that actually we set up our data room even before anyone asked for a particular data room from us. So we had all the information that we thought an acquirer might ask us, and I brought in some external consultants who had been through an acquisition before to help us what kind of information we needed to make sure that's in the data room and so on. So we put that all together. And also we ran sessions with myself and management team and actual, essentially dress rehearsals where we brought in external people who'd gone through acquisition and had done due diligence to come in and grill us about our numbers, about our technology. And it was a dress rehearsal well worth doing. So when it actually came to the final kind of, we got the term sheet that we liked, and we signed exclusivity with the company that eventually bought us. From that point to exit, it only took 6 weeks, which was phenomenally fast. So that's how we went through it.
So developing a high state of readiness and a culture of readiness to enable the final transaction to happen quite quickly.
Yes, exactly, because the last thing you want is, whilst you're going through the real due diligence, is for that to take a very, very long time. You don't want to happen. You want to get it done.
Ian and Adam, I'd like to just talk a little bit about sort of the culture in your businesses. Ian, you joined, I think you were employee number 26, and the company's now got 200, sorry, Adam, and it's now got 260 people. And Ian, you've raised a record £200 million. And when you've got that kind of cash balance in the company, you can imagine people might sort of kick back and fly first class a bit more. How do you sort of maintain that entrepreneurial culture in the business to grow and develop and focus?
Sure. I guess the first thing is around, how do we put this? One of the things that Torsten is always, Torsten's the CEO of Natural Motion, is always very clear about. You've got to be really proud about what you do, and you've got to really, because our games can get out to literally tens, hundreds of millions of people. You've got to be proud, and you've got to be really sure that what you're doing is, in 10 years' time, you want to be able to tell your kids about, yeah, brilliant, we did this, we achieved this, it was fantastic. So from having that type of culture really makes people want to create excellent products, and that's cool. That doesn't necessarily create revenues, but that's a really good way of actually creating that type of family or atmosphere that really wants people to drive to be successful. That's part of it. The second thing as well is I think ever since I started in 2006, we implemented a share option scheme that brought everybody in as owners in the company. So everybody from the CEO to whatever in the middle down to, I don't want to say the receptionist at the bottom, but you get the idea in terms of we wanted people all to feel like they have an ownership in the business. And I think that drives a different type of culture to, because it's effectively your money. That's why you don't go and spend money on first class flights or whatever, because you're all trying to drive the business in the same direction. So I guess the combination of the two, and there's lots of other things in there as well, but I think it's important.
What were some of the growth challenges of growing the team tenfold? And I guess that's sort of accelerated in the last few years. But you've had roles as COO and CFO. You've been in charge of the organisational side of things.
Yeah, I used
what kept you up at night?
I used to joke that COO basically meant Chief Other Officer, which was basically just do everything that was required to grow the business. And things like, the first 100 people I personally telephone interviewed because I was responsible for HR as well as everything else. And I think from a senior management team, one of the things that we knew when we were growing was that we weren't going to get it right. And we tried to get it right, obviously, but we were quite open and honest across the entire company and say, look, we're going to go through a big growth stage. This isn't going to be perfect. We're going to communicate and over-communicate as much as possible. But, it's down to everybody in the company to make this successful and possible. And we used to have lots of people that were whining and whinging. And actually, one of the main things that changed in there is actually bringing them more into we were growing the business, we're doing this for a reason. And, if you're whining, then basically you personally have failed because you're not making the differences in the business that we need to make to grow the business. If that answers the question.
Yeah, the life science perspective, and the industry it couldn't be more poles apart from the sort of trendy tech world of things. But what's your perspective in
we like to think
culture
ourselves a
and
trendy life science as well. So no, we've gone from, I joined as employee 20, we're now up to 60, so it's not this explosive rate of growth, but Steve, the CEO, has sort of a mantra, which is business is all about people. So we spend an endless amount of time interviewing and hiring people. And we recruit slowly, but extremely deliberately. We operate in a regulated regime, so we've got to get our product sufficient to get approved by the US authorities, the Canadian authorities, the European authorities. So there's actually a huge amount of documentation which absolutely has to be right. There is no question about what it has to be. So we grow in a much more structured fashion, and very, very hard to find those people. There may be 10 people in the UK who want the particular job title that we need. We're now getting to the point of having to reaching that limit. We're now having to reach out to the US to bring people in. So there is a limit as to kind of what the UK can provide for the resources we need to expand. To your point around cash, that was very easy because all our cash is already allocated. We don't have any spare. It's already been allocated to particular programs. Oh. So when we now talk about a big part of my role, which is trying to build the company through acquisition, I have to go and raise additional capital for that. So we don't have a cash pile there. Our business is expensive. It costs £50 million to bring each one of our drugs to market now. So that's the type of scale we're dealing with. We have a kind of a very different structure to the tech companies here, which is effectively we have a whole series of project managers in there, and then we're working with consultants underneath. So we have contract organizations, whether it's for running our clinical trials, for manufacturing our products, for actually our early stage discovery. That's all outsourced to other groups, to other specialists, but run by very senior levels of people internally. Our age profile is pretty much in kind of the 40s. It's what you wouldn't really imagine as a growth company, an early stage company, but we've just got a much, much higher age demographic because we're bringing people in who've been doing this for many years before. We have to be careful where we get them from as well. At the moment, Shire is effectively closing down in Europe and Novartis is effectively closing down in the UK. We're very successful about bringing people in from Shire. The people coming in from Novartis is very unsuccessful. We don't bring many in from Novartis because they just have the wrong mentality. They don't have the small cap growth mentality here. And the biggest challenge that I think probably everyone faces as they grow is how do you maintain that drive to succeed? When everything kind of moves into more of a steady pace and you've got a vision, how do you get people to force that vision? How do you get people to make the step changes there? How do you get people to have that kind of that Californian push for the extra style? And that keeps us endlessly occupied between trying to have the balance of making sure everything's done properly, making sure we're covering all the regulatory aspects, but also trying to make people strive for the difference there. And most importantly, Steve's an accountant by history, so the idea of spending money is completely alien to him.
Sharon and Peter, you're both entrepreneurs, and Ian talked a little bit about hiring slowly and very deliberately. What was the sort of key, most transformational hire you made in your business over the years? Was it at the beginning or later on? Or
Gosh, there's so much to say about that, except to say, first thing to say is the pace. I genuinely believe the pace and success of our business is dictated by the pace and speed at which we can recruit exceptional people to the organisation. It's just a fact. And therefore, you need to spend a disproportionate amount of time recruiting in a small company, because in a big company, everyone is, relatively speaking, a pretty small cog. And so if they don't fit quite right, the machine rattles, but it still functions. In a small company, if you don't fit right, the whole company grinds to a halt. And that's why, ironically, and people are often surprised coming from supposedly big companies at how thorough our interview process is, but it's driven by that realization that it matters more for small companies, and the fit, the pool of candidates that actually fit in a small company is actually smaller. So I think that's critical. We obviously have made some key hires, and for us, the person who essentially started up our US operations 7 years ago in the basement of his house, the guy who set up our Japanese office, he's a Cambridge MBA, but Japanese by birth. Again, he set up in his rented flat in Tokyo. And so those people have been entrepreneurs in their own right within the business, and they have been critical, obviously, to the success of those entities for us.
So for Riso, I mean, definitely made some critical key hires along the way, and it's quite strange because you never know who you're going to come across when you're interviewing. And my my philosophy has always been, if you see someone who's really, really good, get them on board, and you'll figure out where they fit later on. So if you feel that culturally they fit, they can survive a small company, essentially hire them. I mean, I had many...
You want to allow a degree of serendipity in your hiring process.
Indeed. I mean, just to give you a couple of examples, I hired my CTO, I changed my CTO, let's say about 6-7 years ago, and made him the CTO at that time, and it was absolutely the right decision. But because we were small, he was also running development. He was actually doing all of the sort of factory engineering type of thing. And later on kind of realized that that's really not his forte. So I actually split that role and brought in someone else. So it's really important to actually bring, I think, really, really good people into your company. And then I think it's the job of the CEO to figure out who really is best at doing what and trying to put that jigsaw puzzle together. The other thing I would say in terms of the culture is it's really important that it's not just about the CEO or the founder. It's about a set of other leaders that you bring into your company. So especially the management team that you're forming, other folks within the company have to look up to them as well. You need almost followers of different types of leaders within your organization. Mm-hmm. And that's what we managed to achieve in the end. We had several very, very key individuals that stood out, in addition to myself, the founder and obviously leading the team, that produced that level of loyalty in each of those departments. And I also agree with what was said before in terms of the share options. I mean, at Ariso, we did exactly the same. We gave share options to everybody, regardless of what level you were in the company. And I think that creates that, shall we say, a family atmosphere or feeling, which means that people actually do go beyond the normal call of duty for the company. And it's quite interesting because now that we've been purchased by a big US corporate, and clearly their culture is not at all like ours, and it's actually creating a lot of friction and a lot of problems for our staff.
In life sciences, it's typical for the management team collectively to perhaps own 15% of the company in aggregate. But remember that if you're venture capital backed, there's often what's called liquidation preferences sitting above that, and that can become a very pernicious problem for the business as you go through many rounds of capital. And I urge any of you in that situation to deal with that ahead of time, because it misaligns incentives, and that's a very specific point. But if any of you are in that boat and you want to know how you would address that situation, we have some experience in dealing with that.
For my specific situation, I would say the management owned about 10%. Obviously, as founder, I owned a big share. So that's roughly. So if you want examples, for example, my vice president of sales owned about 1% of the company at the exit point. Of course, we raised money, so there were several dilutions along the way. So
first of all, just to say, we're a UK company, we're a PLC. We chose to remain domiciled in the UK because of the advantageous tax rates. So that was a clear decision. Then the decision about which market we should go to was dictated really by where we felt we'd get the most appropriate valuation, not necessarily the highest, although I think it has been the highest. But it's just as much of a problem being overvalued as undervalued, because eventually chickens come home to roost and you don't want to have a misvalue, let's put it that way. And we knew that in our sector that all our comps basically were in the US, and there was a series of investors there that really understood our particular part of the life sciences business as well, and therefore were likely to really understand the business, appropriately value it, and would have a large pool of investors willing to support the business. That was what dictated our decision. Having said all that, we just needed to be at a certain stage of maturity and a certain size of capital raise and a certain size of market cap in order to make that work. Luckily, we were in that sweet spot, but if you're not, there's just no hope of you going to NASDAQ unless you can get a market cap above 200 and you're raising 75, for example, and in which case AIM would be potentially a much better choice. In terms of what's happening more recently with the capital markets, it's clear that the US has had such an enormous flood of new paper over the last 18 months that they're being a lot more selective. Equally, in London, they feel they've kind of missed the boat on that wave, and now there's much more enthusiasm for IPOs. because of the success that they've seen in the US, and now people are prepared to take a little bit more risk in London, and that is wonderful for the British markets, and hopefully that enthusiasm will allow a lot of smaller businesses to get funded and take their first steps on the public markets, and that will be great for the ecosystem in the UK.
So we're the exception. Everyone around the world is kind of looking at us, and we get a lot of phone calls and kind of pokes and pods, like prods like being in a lab. People going, well, why did you go to London? You shouldn't go to London. And the kind of our journey was the one we went to the US, and we didn't fit over there. My history is I've been a banker for being covering the European life sciences sector for 17, 18 years. So I've done IPOs in London, I've done IPOs on the continent, I've done IPOs in the US. So I came into it with a natural bias of going to the US. But absolutely, in our situation, it didn't fit. However, there are negatives to it as well. Although, look, it's great we have some things to look up to and people to say the success stories. The challenge is in Europe, the liquidity of stocks is terrible on the small end. The breadth of equity research is terrible. The knowledge of investors is terrible. Compare those things to the US, it's just light years away from it. For our life sciences companies, we're doing an IPO as a next step in funding. We're not doing it because this is an exit for investors. We're doing it as a stepping stone along the way. We constantly consume capital up until the point when we start spitting out capital, and then it becomes out at horrific rates. But along the way, we just need this as the next step along. So we're
Ian, are you happy with the level of research you're getting? Because I think that's one of the criticisms of, in NASDAQ, there's lots more analysts looking at the companies. Are you satisfied with
We've got great research analysts covering the company, but that was a key part of my job, was to come in and set up the syndicate here. So we've got about most of the good analysts in the sector covering us right now. We're very pleased with them, but for us now to go and attract research beyond that, it's much more of a challenge. I would not, and this is look, there is a constant debate within the board and within management here as well. Is the US right as a next step here? Many people have seen the example of GW Pharma going to the US. I think the thing about GW, what's interesting to me is not the valuation of GW. So GW is a UK company. You might have seen it. It does the cannabinoids, so cannabis for epilepsy, cannabis for cancer pain, the special types of engineered cannabis. And what's interesting there is they actually managed to list in the US and create trading and liquidity in the US market when they did it as a separate listing. Theory tells you that should never happen, but they've proven that the US is just so liquid that they put a little bit of stock into the US market, and it started being a self-fulfilling prophecy, and they get hundreds of times more trading in the US than they do in UK now for that stock. And that opens eyes to a lot of what can be done. As we move forward, we acquire businesses, as we move forward and bring on more US employees, we don't say no to the idea of coming to a US listing moving forward. That level of liquidity, that level of research, that level of knowledge is something which is hard to ignore. But for us, London was the right place to be. We're very proud to be a UK company based on UK research with a major UK operation. But the US is definitely a point for the future as we become larger and more robust.
Comments. I think, obviously investors give you the money you need. I mean, that's like the biggest contribution. And if you choose wisely, if you choose well, then they might be able to actually contribute to the business. One of the key decisions I made when we raised the B round, in fact, with Oxford Capital, and it was Oxford Capital partnered with Qualcomm, who are a big US corporate, as a strategic investor. I actually chose to go with their offer. It was a slightly worse offer than another offer I had from another VC, purely for the reason that I liked the person who was going to be on my board, and I thought he was going to add a lot more value than just the money. So I would say have a good look at whoever it is that's going to be sitting in your board. That's the person you're going to have the relationship with, and that's the person who's going to be fighting on your behalf within the venture capital if you need follow-on money, for example. And it's critical that you're comfortable with that particular person. Of course, if he's from your industry, if he's got contacts, or simply he's got good operational experience, which was the case in Oxford Capital. The gentleman that was on my board, he had been a founder and entrepreneur himself. So I felt that he could add a lot of value to me.
So it's about thinking about what data you need to support your story and making sure you have obtained all that data either by commissioning research or just getting access to secondary sources, as well as getting all your documentation in order, as well as getting your key hires in place. So you can't IPO NASDAQ without a CFO based in the US that has done that before and knows something about running a US public company. You need to have an audit committee experience. There's just a lot of things you need to have. And if you haven't, trying to do an IPO and recruit those people at the same time whilst trying to do an IPO is going to be extremely difficult, nay impossible. So it's thinking about all the building blocks you'll need to have in place to successfully execute that strategy and putting them in place ahead of time. That's really what it means. And there's lots of different areas of business that touches on. It's not just documentation, although that's clearly extremely important.
I'd just like to move the debate on a little bit. Today we're celebrating more than £1 billion worth of value created in a single year in Oxford by 4 companies in the Oxford cluster. I'd like to just ask, to what extent has being in the Oxford cluster helped or hindered your business? Let's open up the Oxford debate. We want to, hopefully this is the beginning of something bigger. I mentioned that we're all aware of other companies in our cluster which are coming through and where more value can be created, and hopefully it's going to create a bit of a rising tide. But what has it meant for you?
I think for me it is very, very helpful in the early days when there were access to incubator facilities. There was a whole network of people you could talk to get advice. But as the company's matured, it's become less and less important, candidly. I think it would be great to have a more productive relationship with the university, but that I know is a challenge for many startups coming out of Oxford. Secondly, I think the other thing that's constrained us here is the access to appropriately qualified people. Oxford is a high employment area. It's actually very difficult to attract people to come and work here due to the cost of living, and the infrastructure is appalling in this county in terms of getting people from further afield to come and work here. So there's obviously, I don't want to duplicate the Oxford Partnership and all the things they're trying to do here, but upgrading the A34, more affordable housing, critical to getting a better labour pool here, which is critical to support growth. And as a consequence, I can tell you that in a company that now employs 220 people, we employ 40 people in Oxford. The rest we've recruited more in the US just because there's a better labour pool of appropriately qualified people. That's a shame. I wanted the centre of gravity to be a little bit more in the UK, but it's because of the constraints that exist here.
Ian, can I draw you in on that?
Yeah,
Staying on the life sciences side.
being the positive one, your positive comment out there was the beginning of something. It's all about the kind of the human aspect of this. It's when you want to hire someone, you want to get the right person. Maybe you want to bring them over from California. Are they willing to take the risk to come to your company? And it may well fold in 2 years' time. If you're moving from California to Boston and a business folds, they could walk down the street to one of another 100 companies that are there. And that's the problem we have here. We just don't have enough critical mass of companies for people to take the risk. And also, people in the sector often have partners or are married to other people in the sector as well. So you've got to find a job for them too. Boston, US, that's easy. California, it's easy. Cambridge, it's a bit easier than here, but Oxford, it's really, really tough. So it's actually those sort of real soft issues about finding a sector which is big enough here. And that's the biggest challenge for us here, and it requires just more companies to succeed to do that, for people to afford the risk to come and do that. So for us, Oxford is close to where Steve lives, and that's pretty much about it. It's close to Henley. For other aspects around there, not very helpful at all.
Good access to PIMS.
PIMS is
Adam,
PIMS is available whenever.
Yeah, I think
You're in a very specific niche in the gaming sector, software development. I mean, how have you found?
I mean, I definitely mirror
being in
the
Oxford?
comments about in early stage. In particular, I think the support network for growing businesses, particularly things like ISIS Innovation, were really helpful in terms of getting us through the early stages, and then remained an observer on the board all the way through to the end. That was helpful. Also, what's helpful is having kind of that je ne sais quoi about, oh wow, they're from Oxford, they must be good. And that is helpful in early stage, but not necessarily later. But it does actually really help you get that early kick into there. In terms of technology, actually, when you look at Oxford and you look at all the companies that are out in Oxford, it's very, very heavily biotech focused. And we were just talking about actually there's a lot of technology innovation and development even in Oxford. If you look, we're a video games company. We're around 150, 160 in Oxford.
actually, when you look at all the video games companies in Oxford, there's 500 people just in Oxford within kind of the ring road, and within commutable distance, there's another 3,000-4,000 in terms of Leamington and Guildford and other areas as well, where there is actually a very vibrant tech community around here, which we just don't really realise about. And I think, from my perspective, I'm obviously we've always focused in tech. I think tech is definitely underrepresented in Oxford, certainly in comparison to Cambridge, or definitely in comparison to Silicon Valley. And I think that's where I'd be keen for Oxford to be seen not just as a biotech, still very strong in biotech, but see where else we can grow as well.
Absolutely. And Sharon, I know you're building a house in Oxford, so you haven't been put off by the experience completely. What's your take on things?
I totally concur with the other speakers. I actually presented in the Sage School Network of Angels 12 years ago, and that's how I met Martin, and it was one of my
That's
first
how
investments.
I first saw you there as well.
That's true. Yeah, that's true. Well, you invested at the right time. That's just. But so it was very, very helpful in the early stages of the business, and that's really the critical stage of any business, that you need that kind of network of support. I could rent a desk, for example. I couldn't afford an office. And just little things like that for those founders and entrepreneurs who are trying to get their business off the ground and require that network of support. And of course, you've got the monetary aspect where you can raise money. Later on, I wouldn't say it's helped as much. Certainly, it's good to become part of these types of forums. I'm actually part of the Cambridge Forum, and I found their kind of networking a lot better than has been in Oxford, certainly for technology. They put conferences like Business of Software and that kind of stuff, which I attended a couple of weeks ago, and it's excellent for people or for companies of any type of size to get together and exchange ideas. So it would be lovely to see something similar in sort of a bit nearer to where I'm building my house.
So actually, all of your experiences echo a little bit the points I made earlier on, that it's a good place to be starting a business, but actually then growing a business. Once you're beyond the tadpole stage, out of the pond, things like life is challenging anyway, really.
I think one other aspect is actually office space, which in Oxford is really, really tricky. I mean, we're very lucky. We've got 18,000 square foot right in the centre of town, which is great and totally unheard of. But Oxford's pretty good outside in the ring road, but the transport links out there are not as good if you're based in the centre. And so
I understand there hasn't been a commercial development in Oxford for 20 years.
Yeah, wow.
Which is a major surprise to us.
But even the ring road, it's not that great. Sort of, the science park is completely full. There's no more space there, and no one wants traffic jams on the business park. So there really isn't any.
So I'm sure there's some people here from the council who are listening carefully. There's some important things to sort out here. One of the last sort of great companies that was built here in Oxford was Powderjet, and I remember from when that was sold, it was valued about $800 million, I think, or something. And but it created quite a lot of wealth. It created a lot of people went through that entrepreneurial journey, and as the result of which, a number of companies have been started. And I know at Circassia you had various people. Peter, you were at Powderjet. You're part of that legacy. How did you see that sort of recycling of experience? Has that helped you in your journey?
Yeah, I think when you look at the number of companies that came out of the success of Powderjet, there's probably 15, 20 CEOs came out of that business and started their own company, and that had to do with having the experience of going on a very successful entrepreneurial journey in that business. And there's no doubt that kind of success begets success because it generates the kind of experiences that you need to subsequently be successful. And so one hopes that as more and more companies become successful in this area, that the labour supply and constraints that I talked about will gradually diminish as we have more and more people who've been there and done that. So I think it's a very positive thing that we're seeing some successes, because I hope it will improve the whole ecosystem.
And I think just one last one on the Powderjet example. Powderjet was interesting because it was a reinvention along the way, at least once or two times, of completely different business models. So it gave people the bravery and the encouragement to actually try different things moving forward. So Powderjet was one technology that was good, gave a market cap to enable to go up and do a completely different business as well. And that sort of dynamism in the way to develop a business is key there. But since we've got many of the team on board. It also helps when it comes to the IPO. People say, you've made money for me before, so I think I'll give it a punt again. Don't bother reading the documents, just punt on the track record. Usually a better way than reading the documents in general. But I think that is. US entrepreneurs, they've done it 5, 6, 7 times. They've probably failed 3 or 4 times along the way. No one expects you to get it right even half the time. So that's critical for success of the area.
Ladies and gentlemen, I hope you enjoyed this panel. Thank you very much for joining us, and please show your appreciation to our panelists. £1 billion! Well done.